Here we see distributions per unit, or DPU, for the fiscal period under review and thereafter. As announced when we made our public offering, in the fiscal period ended May 31, 2022, the 41st fiscal period, DPU rose 160 yen from the previous period to 3,050 yen. DPU for the ongoing 42nd and the subsequent 43rd fiscal periods is forecast to increase 65 yen from the fiscal period under review to 3,115 yen. This result clearly shows the effects of strong results in both offices and residences and of public offerings in 2 consecutive years. It also shows that the likelihood of external growth going forward has increased. Our medium to long-term vision, Next Vision, calls for DPU of 3,300 yen, assets under management, AUM, of 300 billion yen, a AA- rating, and 100% reliance on renewable energy. The targets for credit rating and renewable energy are already achieved. On DPU, we passed the turning point ahead of schedule. Here we present the compass that will guide us out of the rough economic seas we find ourselves in now. Serving as our base is the solid financial foundation that results from the steady improvements we've made to our constitution even during the COVID-19 pandemic. We have a diversified portfolio of 119 properties, ample free cash of 7.1 billion yen, sufficient internal reserves of 5.3 billion yen, low LTV on an appraised value base of 38.9%, and commitment lines of 7 billion yen. And in the fiscal period under review, our credit rating was upgraded to AA-. Supported by this solid financial foundation, we are implementing 5 measures. The first is investment corporation management that leverages the combined strength of the HEIWA Real Estate Group. We have consolidated property management operations on properties handled by the HEIWA Real Estate Group into HEIWA Real Estate Property Management. The success of HEIWA Real Estate REIT in achieving an incredibly high office occupancy rate of 99% shows the effectiveness of this consolidation. Our second measure consists of the improvement of our ordinary EPU through asset replacement as well as realization of unrealized gains. In the most recent public offering, assets were switched between HEIWA Real Estate and outside parties, increasing ordinary EPU and realizing unrealized gains. DPU rose dramatically as a result. Given the company's current condition with its increased unrealized gains, we expect this measure to continue to be highly effective. Going forward, we will strive to strengthen our portfolio and return value to shareholders. The third measure is property acquisition without competition. From an early stage, we have acquired properties in which other companies cannot compete, such as development of general land leasehold rights and acquisition of properties for co-ownership and sectional ownership. HEIWA Real Estate REIT has worked hard to establish this approach firmly. These efforts are widely recognized by vendors and intermediaries alike, enabling us to obtain highly reliable property information. The fourth measure is realization of office rent gaps. Rather than focus solely on capitalization rates when acquiring properties, we appraise rent conditions on an individual tenant basis. We then strive to purchase buildings in which rent gaps are found. As a result, we have succeeded in expanding the rent gap in our overall portfolio, even in the current challenging environment. Going forward, having acquired this rent gap, we will strive to close it in both new and continuing properties. The final measure is the improvement of earnings on the back of recovery in demand for urban single-occupant residences. During the fiscal period under review, rental adjustments combining new and continuing residential properties turned positive. This breakthrough makes clear that areas that suffered during the COVID-19 pandemic are now on an improving trend. Going forward, as people's daily lives become more active, demand can be expected to rise. We will do our best to capture that demand firmly.